Hi everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be discussing restricted stock options, and performance shares. So these are three different types of employer company stock grants that you may be already receiving, or maybe you just recently found out that you're going to be eligible to receive these in the future. So hopefully this video and the information that I'm going to provide to you today will help you to understand these a little bit better and some of the things that you need to think about as you're receiving these grants. So what we're going to talk about today is, first of all, what are some of the rules and things that you need to think about as you're receiving these grants? We're going to talk about, what are these grants worth to you, and how does that maybe incorporate into some of your long-range retirement planning and cash flow. We're also going to be talking about some of the decisions that you need to make maybe as you're receiving them, and some of the things maybe at tax time. So we're going to be talking about some of the tax considerations as well. So this video that we're doing here today is going to be part of an entire series that I'm working on right now, where I'm going to be focusing on some other forms of non-cash compensation, things like employee stock option plans, deferred compensation. We're also going to circle back around and maybe revisit some of the other more traditional forms of retirement savings plans, like 401k plans and maybe after-tax savings options that you have through those plans. So this is going to encompass a whole suite of videos that are going to help you to hopefully be more educated and figure out how you can best take advantage of some of these employee benefits that you have. So anyway, if you haven't already, be sure to hit that subscribe button. And if you're watching this video and you're thinking, hey, this stuff kind of makes sense, or maybe you think you want to get a little bit more help on this, you can head over to wealthvisionplan.com and you can learn more about our financial planning process. So with that, let's dive right in and let's learn a little bit more about restricted stock and restricted stock units and performance shares. Okay, so let's begin by, first of all, understanding what exactly does this company stock grant mean for you. We're going to begin by looking again. There's three different types of company stock grants that your company may issue to you. The first type is what's just called restricted stock. And we're going to get into each of these in a little bit more detail here and understand what the differences are. Then there's something called restricted stock units, or they sometimes often abbreviate that as RSU. And then there's performance shares. And so the one thing that pretty much all three of these categories have in common is that they are restricted. In other words, as the company is granting those shares of stock to you, they're not immediately available for sale. Oftentimes there's some other criteria that has to be met before that stock truly becomes yours. Most commonly, that's going to be a vesting period. And so that's going to be true of the restricted stock and the restricted stock units. For example, they may issue you 1,000 shares of company stock, and they may tell you that over the next 4 years, 25% of that stock is going to become vested each year. So at the end of year one, as long as you're still working for the company, 250 shares of that stock are going to become vested. At the end of year two, you're going to get another 250 shares, and then so on until after the 4-year employment criteria, you're going to have all of those 1,000 shares there. The difference of the performance shares is going to be, those are going to be based off of some other metric. It could be earnings per share goals, or it could be a sales or revenue goal that the company has, or shareholder return. There's a number of different things. There's really lots of different things that the company could put on as a restriction. But in order to get those performance shares, it's not just simply a matter of time, but there's also going to be some other goal that has to be met in order for those shares to become truly yours. Okay, so let's talk about the mechanics of how this actually works when you receive a grant of company stock. So let's begin with the restricted stock. So when you receive a restricted stock grant, what the company is actually doing is they're actually transferring those shares of stock into an account in your name. However, those shares of stock are actually held in an escrow account for you. So in other words, again, just like we're talking about here, restricted stock means that you don't have the ability to sell those shares or do whatever you want with them. There's some criteria placed on it. Again, most commonly that's going to be a vesting period that you're going to have to work for the company for a certain period of time before those shares become vested there. So again, those are held in escrow, and if you don't fulfill the requirements of that vesting period, the company is actually going to take those stock shares back. Restricted stock units are going to work a little bit differently than the restricted stock. So just like the name implies, restricted stock units represent units of those shares of stock. So unlike the restricted stock where the stock shares are actually transferred into an account in your name and held in escrow, with the restricted stock unit, you actually don't get those shares of stock transferred to you until the vesting period is completed. And so because of that, as we're going to learn here, there's going to be, I think, a few more advantages to a restricted stock versus a restricted stock unit. So with performance shares, those are going to work a little bit differently as well. Again, performance shares are basically just a form of restricted stock where there's going to be some criteria that's going to have to be met before those shares become eligible. Most likely it'll be something like earnings per shares goals or revenue targets, sales targets, and that sort of thing. And so with performance shares, they could have those performance metrics that you have to meet, as well as a time requirement as well. So they may not be able to be vested for a year or 2 years or 3 years, or they may become vested right away as soon as that performance metric is reached, regardless of how short of a time period that may actually be. So those are going to work a little different. With performance shares, they have performance stock units, and they also have performance stock shares. And then so those are going to kind of fall into, so under performance shares, you're going to have basically the equivalent of performance stock units and performance shares that'll have some similar options and criteria as we're talking about here with restricted stock and restricted stock units. Okay, so let's talk about a few more differences between restricted stock and restricted stock units. First of all, voting. So with restricted stock, you actually are able to vote those shares. So even though the shares are not fully vested, because those shares of stock have actually been transferred over into an account in your name, you're actually able to vote those shares, which I think is a very important consideration there. With restricted stock units, because the shares are still held back at the company and won't actually be transferred to you until that vesting period has been met, you do not have any voting option with the restricted stock unit. The other thing to think about are dividends. So you can actually get dividend income from either one of these, restricted stock or restricted stock units. However, I think it's going to be a lot more likely that you'll be receiving restricted stock dividends as opposed to restricted stock unit dividends. Again, because those shares of stock are actually held in an account in your name. However, the way the income is actually used for tax purposes with a dividend from a restricted stock or restricted stock unit is going to be considered W-2 income. And so that's just like your regular form of compensation. Again, because the shares of stock have not actually been transferred to you, then any dividends that you receive, or basically, kind of pseudo dividends in the case of a restricted stock unit, because again, you don't have those shares. So if the company decides to be nice and pay out the dividends representing those shares, that too will also be considered W-2 income. And again, going back to our tax planning that we've done in a lot of other videos, you know that W-2 income is going to be at your highest marginal tax rate as opposed to what normally happens when you receive qualified dividend income, where it gets that preferential tax treatment. The last key difference between restricted stock and restricted stock units is going to be something called the 83B election. So 83B is a tax election, essentially, and we're going to talk about taxes in just a moment here, going through all the mechanics of how this works, when you pay taxes at vesting, when you pay taxes when you sell the stock. But 83B election is a very important thing to know about if you have restricted stock, but it only applies to restricted stock, not restricted stock units. So very important distinction. And again, unfortunately, we don't get to choose whether a company is offering us shares of restricted stock or restricted stock units. We have to go with whatever they have. But again, 83B is going to be one of those very important tax rules that we want to know about if we're doing our planning correct for taxes. Okay, so now let's move on to tax considerations. What we're going to talk about here is kind of unilaterally, the rules are going to apply to restricted stock as well as restricted stock units, kind of in the same manner, except for when we start getting into the 83B election, which again, those are only going to apply to the restricted stock. It's not eligible for the restricted stock unit. So first of all, let's use our example that we've been talking about here. Let's say that your company issues 1,000 shares of a grant, and let's say today the stock is worth $25 per share. And so if you were able to sell that stock right away, in other words, there was no vesting requirement, you'd be able to sell that stock immediately, and essentially it's like getting a $25,000 bonus. However, as we're talking about here, the thing that makes it restricted is the fact that they put some vesting schedule or criteria on that in the case of a performance share. So let's say that this is going to be a 4-year vesting, and 25% of those shares are going to vest on every single year. So 250 shares at the end of year one, another 250 shares at the end of year two, and so on. So at the time the grant is awarded, because that stock is not yours to sell, and there's what they call a substantial risk of forfeiture, there is no tax due at the time that grant is awarded. However, as those shares are vested, that's when we start having to think about taxes here. So let's say that at the end of year one, let's say that the stock has done pretty well and it's gone from $25 a share to $30 per share, and we have 250 shares that have just matured, so that's $7,500 that those shares are worth at that time. And so again, the way we want to look at this, or the way the IRS, I should say, looks at this is a form of non-cash compensation. So contrary to some of the other rules that apply with capital gains and dividend income and things, this is a form of your regular compensation. It's going to be taxed accordingly, just like your other forms of W-2 income. So you're going to have to pay federal income tax. You're going to also have to pay state or local taxes if that applies, depending on where you live. You're also going to have to pay Social Security tax if you haven't already reached the maximum threshold for how much of your income is subject to Social Security tax, and Medicare taxes as well. So just like any other bonus that you may have received or may be receiving, the only thing this is tied to is the stock. So it's just essentially like your company gave you $7,500 and immediately turned around and bought shares of company stock, and if you kind of think about it that way. But again, you receive $7,500 here, and the IRS needs to get some tax money, so there's going to be some withholding, and this is one of the most important things that I think everyone needs to understand. Different companies have different methods for dealing with this. Probably one of the most common methods is where, as you're receiving these blocks of stock, as they become vested, you have the option to effectively sell or have the company withhold enough shares to cover your withholding. And so the withholding is going to be just like basically any other kind of windfall type of a bonus, basically supplemental income rules. And so if it's under $1 million, for example, the federal income tax withholding is going to be just a straight 25%. If it's over $1 million, it's going to be taxed at the highest income tax bracket. So it's important to understand, how, that's going to work. So maybe in this case right here, if you were doing that and they were going to withhold enough shares to cover those tax withholdings, or maybe have an immediate sale to cover those tax withholding, maybe instead of getting 250 shares, maybe you're going to get 220 shares, or whatever that math happens to work out based on the other factors in your income tax situation. One thing to keep in mind as it relates to the income tax withholding as a result of having those shares vest is you want to keep in mind that the amount of tax withholding may not necessarily correspond with the amount of tax that's actually due as a result of those vested shares. In particular, I think it's important if the amount of tax that's going to be due is significantly larger than the amount that was withheld, you could end up with a really big tax bill come April. So you want to make sure that you're aware of this and you've done some calculations to see how that withholding compares to what you think the actual tax may be, and maybe set aside some money to be able to pay that tax in April, or if the amount is large enough, you might want to actually consider making an estimated tax payment. One of the things the IRS doesn't like is they don't like getting their money soon enough throughout the year, so if you don't send those estimated tax payments in, and that discrepancy between the amount that you actually owe is large enough, you could get hit with some additional penalties. So make sure you're aware of how that vested share actually impacts your income tax situation. And especially, hopefully, as you continue to do well with your company and your company does well, imagine if we started adding an extra 0 or 2 onto the end of these, which would be great. But again, those tax bills are just going to get that much larger at that point. So we just learned about the tax implications as those shares of stock vest. Now what we want to do is we want to talk about what happens when you actually go to sell the stock. So let's continue this, and let's just say we're talking about this one kind of tranche of shares here, this 250 shares that vested at the end of year one here. So at the time that those shares vested, the stock was valued at $30 per share, so we paid regular ordinary income taxes on the $7,500. Let's assume that the stock continues to do well, and it goes from $30 and let's say it goes up to $60 per share. So we now have an additional gain of $30 per share. So one thing that's important to know is that the same type of rules apply to the restricted stock or restricted stock units as they do to regular ordinary stocks. In other words, the capital gain, the short and the long-term capital gains tax rules. So if it's been more than a year since those shares of stock vested, then we're going to be in the long-term capital gains tax rate. And if it's been less than a year since those shares vested, we're going to be in the short-term capital gains tax bracket. And as we know, the long-term capital gains tax rates, at least as it pertains right now, are significantly better than the short-term capital gains. So let's assume that this has been longer than a year. And so if we go to sell those shares of stock, those 250 shares, we're going to essentially report a $30 gain or an additional $7,500 as a long-term capital gain on our income taxes. And so that's basically for either a restricted stock or a restricted stock unit. What we're going to talk about now is the 83B election. And I think this is, again, something that at least you should consider and understand how it works and see if it's something that you feel is right for you based on what we're going to talk about right now. Okay, so now let's talk about the 83B election. So as we talked about here, the 83B election is something that's going to apply to your restricted stock. You cannot take a 83B election for restricted stock units. So that's a very important thing to make sure that we're aware of. So basically, if you elect the 83B, you're going to notify the IRS within 30 days after you receive an award of restricted stock. And you're basically going to tell them that you want to take this 83B election. Let's keep our example there where we got 1,000 shares of stock, and at the time those shares were granted, the share price was $25 a share. So under 83B, we're going to say we're going to pay taxes today on $25,000. And what that's going to do is it's going to give you a couple of advantages. It's also going to give you a couple of things that could be disadvantages or at least some potential pitfalls that I think we need to be aware of here. But that $25,000 is going to be taxed, again, at your W-2 ordinary income tax rate. It's going to have all the regular tax withholding that you normally would have with that. The advantage is that that's going to now set your cost basis. And as those shares start to vest, if that share price, like we've been talking about here, goes up and maybe does very well, it goes up to $50 or $60 per share, as long as we've had at least a year, 12 months since the time that we made that 83B election, we're going to qualify for a long-term capital gains tax treatment. So even if, let's say, the first vesting period is exactly 12 months from the day they were granted, and we sell that stock right away, since it's been a year since we elected 83B, we can almost immediately sell the stock, and even if it's at a gain, we can have that be at a long-term capital gains tax rate. So it gives us a little bit of advantage there. If we're receiving dividends as a result of the ownership in that stock, because we've done the 83B election, we're going to get that treated as a qualified dividend, which is going to hopefully be a better tax treatment than having it taxed at your ordinary income tax rate. So there are some advantages to doing the 83B, especially if you feel like your stock is going to continue performing in a good manner there. Exactly. So why would we do an 83B election? And again, what are some of the pitfalls of that? So if we think the stock is going in a good upward direction, it can give us some better tax treatment on the growth of that stock from the point of time when that stock was granted to the time that the stock actually vests or when we actually go to sell the stock. So that's going to give us some additional advantage there. We also have to believe that our employment is going to continue. So if we get granted those shares, we take an 83B election and something happens and we no longer work for the company, we didn't meet that vesting period, well, we just paid a whole bunch of taxes that we didn't have to pay. It's not going to be a very good thing, basically. So we want to make sure or have a pretty good idea that we're going to be able to stay employed with that particular company. A couple things, it does force us to paying that tax a little bit earlier. So we definitely need to do some planning to determine, where that fits in with your overall financial planning strategy, where it fits in with your income tax strategy as well. Sometimes it makes sense to delay paying taxes. In fact, when I went to school and I took tax accounting, that was almost every scenario we worked on. It was how can we push taxes out into the future as far as possible. But right now we have, as we've talked about in some other videos, we have some different tax rates that we're currently in. Those tax rates are set to expire in a few years at the end of 2025. So all of those things need to be kept into consideration of whether or not it makes sense to pay that tax now or pay the tax later. And again, what do we think is going to happen or likely to happen in our opinion of that particular company's stock. And also, keeping in mind too, the biggest risk of this is potentially forfeiting that. So if you take the 83B election and you pay that tax and you end up forfeiting the stock, that's going to be a situation that nobody's probably going to be very happy about. Okay, so I hope this is all making sense so far. So I hope that we're shedding some light on helping you to understand a little bit more about how these restricted stocks or restricted stock units work, and some of the things to think about there. We talked about the 83B, the tax consideration. So just a few more things to kind of point out here. One thing as it relates to income taxes, 2015 they made a change with the way that this gets reported. So we talked about our example here just a minute ago, where we said we acquired the stock that vested at $7,500, which was the amount that we declared as our W-2 income, but then the stock in our hypothetical example went up to $15,000. So you got the $7,500 capital gain at that point. The company is not going to be reporting that $7,500 of W-2 income as a cost basis. What's going to show up on your 1099-B is it's going to have 0 as the cost basis there. And if you're not careful, you could end up paying taxes on the full $15,000 when in reality, in this example, you should really only be paying that capital gain on the $7,500. So you want to be aware of that, whether you're doing your own income taxes or you're having somebody do that. You want to make sure that they're considering and adding to your cost basis the amount of W-2 compensation that you already pay taxes on. So we don't want to double pay taxes on that. You also want to read through some of the rules. In particular, you want to understand, how these vesting rules work if you were to retire, for example. So, if you leave the company, you quit, you go work for a competitor, you're going to lose those shares. But what happens if you've been accumulating shares as you approach retirement? You just hit 65 years old or 62, whenever, and you still have a few more years of vesting left. Do they allow you to continue that process of vesting, or do you have those shares simply cut off? So that's a consideration to think about there. What if you become disabled and unable to work, or what if you die? What happens to those shares of stock if you pass away? Does your family still have that? Do they get vested? And lastly, too, especially a lot of companies that issue this sort of thing, the company could be acquired by another company. So what happens then? If company A buys company B, what happens to those company A shares of stock? Do you immediately become vested? Those are things to understand and consider. And this is something too, as you're doing your financial planning, company stock and restricted stock units, what we're going to talk about in some future videos, stock options, these can all become very big parts of your overall financial retirement planning. And so as we start looking at all of these different moving parts, the money coming in, money going out, shares of stock getting vested, what is the impact on your cash flow? What is your impact on your tax situation? And so it requires some pretty advanced planning. And I mentioned it earlier, I think, in the video. But if you're interested in the kind of planning that we do, where we can help you to map all of this out, we have something called the Wealth Vision Financial Plan, and you can head over to wealthvisionplan.com. You can learn a little bit more about that. But we actually have the ability to completely map out these restricted stock options and restricted stocks and see, as these shares become vested, put in some hypothetical growth rates and see what future impact it might have on your income taxes, what that's going to do potentially for retirement, and really give you the right tools as we're working together through this to be a little bit more confident and to make some better informed decisions about your money and which options you should maybe elect. Should you do the 83B election? Where should you be contributing money? Deferred compensation? Again, all those different moving parts. So that's wealthvisionplan.com. If you haven't already, check that out. And if you haven't already, subscribe to our YouTube channel. Again, we are continuing to do videos on a pretty regular basis, and we're going to finish out this series where we're talking about these employee benefits and I think some good things to come. So hit that subscribe button, and we'll see you back here soon in one of our next videos. Thanks.